The GOAT, the on-chain analyst of all on-chain analysts, my favorite, James Jack, is showing us today three particular things. The first thing is, why the heck did 2025 not perform from an on-chain perspective? What was actually going on? And also the relationship to gold with that. The second thing is the setup that we currently have for 2026, and how does he look at what could potentially happen for Bitcoin in 2026. And now the last one, the most important one, the most fun one. What are the triggers? What are the things that he looks at that he sees a major Bitcoin bull run? And yes, 2026 looks very, very good, but I don't want to spoil you anything. James Jack can explain it to you way better. Enjoy. I was really excited, or I am really excited to actually talk to you, because I think there's a lot of feelings always out there in the market. And you are one of the guys that actually bring data to the feelings. That's how I describe it.
Often the data is the feeling, right? Oh, I can see there's a bunch of people who are underwater. It's then you check Twitter, you're like, yep, that's about right.
But there's also this thing going on where I feel like Bitcoin Twitter represents the last 10 days of memory. If the last 10 days has been amazing, Bitcoin Twitter feels amazing. If the last 10 days has been bad, Bitcoin Twitter feels really bad. And so this not always represents what's actually going on on Bitcoin on chain or in the data.
Yeah, so my general view of 2025 is the thing that a lot of people missed was the hodler sell side. And I've done so much work just looking at how big it was. And that's been, in my opinion, that was the headwind. And, you can look at it from, people love to argue it's not a long-term holder if they haven't held it for 45 years and they weren't there at the Genesis block. They're not really an OG. Everyone's got their own opinion. But the fact is, we saw the most amount of coins, whether you want to age them 6 months plus, 1 year plus, 5 year plus, choose your denomination of aged coins. This cycle, 2025, we have never seen that many old coins come back relative to the market size. Since April, it was just a one-way street up where it just kept ticking higher and higher and higher. The price starts curling over. Once we got to the all-time high, in October, we were seeing $3 billion a day coming back to market. So a lot of people are saying, how on earth can Saylor buy 10,000 coins and the market goes down? It's his hodlers are selling 12,000. That was really the big theme in my view. And I ran a study yesterday, actually, where I compared how much of the profit taking in 2017, 2021, and 2025, how much of it was long-term holder driven. Now, in 2017, it was only 20%. So if you think about this from a behavioral standpoint, I think we learn a lot about Bitcoiners by studying on-chain data. In 2017, the general theme was that it was a quick buck. So 80% of the profit taking that was occurring were people who bought within the last couple of months, basically rinsing profits in and out, taking money in, taking money out. When we got to 2021, that was 33% was long-term holders. The other 70-odd% was coming from short-term holders, quick swing traders. This cycle, 2025, 75% of the profit taking was long-term holders. And this is 1-year-old coins plus. So there was a mass exodus of people who've been in the market for a very, very long time. Could be a year, could be 2 years, could be 5 years. Again, doesn't matter which denomination you choose. There was a lot of, and I would put that down to kind of two major buckets. One, we just genuinely saw people who've been in Bitcoin for years. And remember, if you hold a coin that's 3 years old, you may have bought it 10 years ago or 8 years ago, and you've swapped wallets and you moved it around. That's where all the nuances come into it. But the point is, a huge amount of people who've held Bitcoin for a long time, multiple cycles, 100K was their level. And it just took time for that distribution to happen. And there's another pool of people who are expecting 2025 to be the classic 4-year euphoric moon mission. And after 6 months, they got bored and they're like, I need to go into NVIDIA, or I need to move into gold. I need to, they're momentum traders that switched out. So both of those parties were just tremendous amounts of selling. 2026, that metric, revived supply, is falling like a stone, dropping off a cliff. So the marginal sell side, as it stands right now, is just falling off a cliff. And I wrote a report yesterday. It's very, very early. I don't necessarily think we've cleared the idea of I'm viewing this as a bear market and for the time being. That's my current setup. But I'm very, very willing to swap my bias because we're seeing sell side coming down and we're actually seeing marginal demand kicking back up. Whether via strategy, using their stretch product, whether via the ETFs, they had their first good inflow week since the all-time high. Again, one inflow week is not a trend, but it's a good start. So I like the general structure of what's going on. I'm not yet ready to say that I think we're out of the bearish territory. So we're somewhere at this like almost decision point where the market needs to work out, are we at the start of 2022? Or are we somewhere in like mid 2021? Or are we starting some kind of a new market cycle? Have we reset psychology enough? So we haven't quite got I don't think we've really got enough of a story to say which one it's going to be. But I'm certainly entertaining both ideas.
And I really want to talk also later in the podcast about stretch and strategy, because I think it's like so misunderstood from TradFi and Bitcoiners, which is really fun to see. First, I'm curious about like how you also see that, because I think 100,000 was actually like a really interesting point, and I forgot his name now, but the guy that was writing about the silent IPO last year.
Oh yes,
I found that. Oh, Jordi Visser, yes. I found it really interesting. And if you think about it, like a lot of people maybe came into Bitcoin like 2020, 2021, where like the big uprise was, where like Elon Musk, like all the thing, like all the euphoria, all the drama was happening. If you bought somewhere in 2020 around like 3K, 5K, 10K, you made a 10X. You made like maybe even like a, I don't know, like a 12X, 13X, whatever the X is, wherever you bought it from. And this is like in a 5-year span. Someone that bought an asset, hold it for 5 years and makes a 12X, he got significantly wealthier. And at the same time, there was always this like, oh, laser eyes till 100K, and like this psychology going on of like, we hodl till 100K and like all of those things. Then you reached 100K and the focus kind of got lost. Like the focus was kind of like distorted, and a lot of people got really wealthy the last 5-6 years. And so like, of course, maybe you want to buy that like great house for your family, or like your car needs an upgrade, or like, I don't know, like what do you want to do? You want to retire maybe, and you're like, hey, like I have 50 Bitcoin, I guess I can like lay down a little bit lower now, because like I have a lot of purchasing power. And so I think there's like just like a lot of things coming together with like 100K, the 25 years and all the things. How do you look like at the psychology side of the Bitcoin 25 year?
Yes, no, I think all of those points are really valid. And I liked Jordi Visser's piece. It was called A Silent IPO. And his general thesis was, we see this in early stage tech companies. The early investors, they know it's going to the moon, but they've been there for such a long time. They've been through the ups and the downs, and there's a lot of downs in early stage companies. There's been a lot of downs for Bitcoin. People get tired. And also I think a lot of Bitcoiners get stuck with it's the best asset in the world, which it is. It's the best asset in the world. Therefore, why would I ever sell it? And therefore, why would anybody ever sell it? And that, I think, is a trap, because the truth is, if you think about where a lot of Bitcoiners are, and you can look at the demographics, we do surveys of our subscribers. We can look at our YouTube statistics. Like you name any podcast, they'll give you the exact same statistics. Millennials are the dominant proportion of Bitcoiners. Like they are the largest bulb of them. And where are millennials in their life? I mean, I look at where am I in my life? I've got a son. I'm looking to buy a house. I've got literally in the home building phase of my life, which is the most expensive part of life. There's going to be private school at some point. Like all of these things are things that I'm planning for. I'm going, how much Bitcoin do I need to hold? When do I sell it? What do I do with it? All of those dynamics. And also it's a relative market. People who are sitting there in Bitcoin watching gold ripping and watching Nvidia ripping and watching like other things go up. By the way, I love this whole concept. The way that Bitcoiners feel watching gold and silver rip, there's 2 ways to solve that. One, understand that like that's literally how Peter Schiff has felt for 15 years, 17 years. Like we're getting a bit of a flavor of what that feels like. But the other one is, this is why I hold gold. I hold gold for specifically this reason. I would hate if I found the house that I wanted to buy right now and I needed the deposit money. I would hate myself for selling Bitcoin at 90K, because I know that 90K is a horrible price. But my gold was absolutely ready to go. It's my liquidity buffer. I could sell it tomorrow. I wouldn't think twice about it because I'm exchanging it for the house. So like actually owning a bit of gold, I think a lot of Bitcoiners have worked out, maybe I shouldn't be 100% Bitcoin. because they're realizing that it's a tool for a job. And there's nothing worse than Bitcoin being down and you having to, like, being a forced seller, not because you have to sell the Bitcoin, but because the thing that you wanted to buy needs to be bought today, right? Could be schooling, could be house, whatever. So just thinking about where people are in life, like life is dynamic, life changes. I see very often comments where people are like, but it was 100K for the first time in February. Why didn't they sell then? Why did they choose to sell later on? It's like, well, life changes over the course of 2025. Like, decisions take time. I often think back to that guy who sold 80,000 Bitcoin, like at the top, props to him. Imagine cashing out $9 billion at the top. So that dude, imagine the thought process that he's gone through, he or she, having bought it back in 2010, I think it was. He held it for 14 years. And he's like, I'm going to liquidate $9.6 billion worth of Bitcoin. Imagine how long it takes you to like do the compute cycles and think about the mechanics and engaging Galaxy as the OTC. Like, just that's a decision that you don't go like, oh, I'm going to wake up one morning and just like, just casually sell $9.6 billion. Like, it takes time for people to think about this stuff. It would take time for me. Even if I was to liquidate a small portion of my holdings, I would like plan it out. I have a game plan for what I'm going to do. So I just think that understanding life is life, and holding Bitcoin is a great part of it, but it's not the only thing people do. It is a tool for a job for most people, because as Saylor would say, right, you can't do anything with your Bitcoin, and some people are going to die with their Bitcoin. I think that's a mistake, because your life is more precious than the Bitcoin. And I think a lot of Bitcoiners have probably worked out now that they've got wealth, they've got actual wealth, they've got ahead over the last couple of years. They're just looking at life circumstances and saying, well, I've only got a short amount of time on this earth. My family needs things. How do I look after them? And like, can I use my Bitcoin to do that? So in my view, that's a big part of it. There's the IPO moment. There's the where Bitcoiners are in their life. There's 100K just being a psychological level. There's cycle traders who just are so convinced in the 4-year cycle that they're like, oh, it's going to be a bear, I'll sell it now. There's all of these things. And then once you start to sell off, there's a bunch of people who've been sitting over the sell button being like, they're indecisive. And they're going, oh, but it's 110. What if it goes to 150? I'll wait. Oh, no, it's 100. Hang on. But what if it bounces from here? And then it goes down to 80. They're like, oh, man, I missed it. So I'm going to wait for the relief bounce. And then, oh, you're going to give me 95? You're going to give me 100? They're going to feel that feeling to exit on the way back up. And ultimately, that's what creates bear markets. The real question is, does the demand come in to actually absorb that sell side? Because once we flip over and really start trending higher, a lot of those momentum traders who switch into gold, who switch into NVIDIA, who switch into something else, they're going to start seeing the asset that they actually wanted to own, but they sold because they were impatient moving, and they're going to come roaring back in. So, markets are a process, and I think it's important to think about them as such.
This is really interesting. The momentum traders, like, it's so hard for me to think of, because like all my life I've researched the thing and then just like owned 100% of it. First Tesla, now 100% Bitcoin, and just like stick with it and haven't sold anything in a very long time. I'm really curious. I think we talked about it last time. You said like your Bitcoin plus gold as cash. So you still have that the portfolio where you like have a gold reserve and a Bitcoin reserve.
Yes, 90-10. And to be honest, I made a deal with myself in about, I think it would have been about 2020. Because in 2020, I held a bit of gold as well. And I'm pretty sure I was driving down the freeway. I was listening to Michael Saylor. It was when Saylor had only just come on the scene. It would have been like August, September. Bitcoin's like 10K. And I'm driving down the road listening to him talk about this thing. And I was like, and I've already done the work. Like, I'm already majorly long Bitcoin. But I was like, I probably should have some gold as well. And I remember making the decision, I'm going to sell my gold and put it all into Bitcoin, which was a great trade right before the 2021 bull. So that was a good decision. But I made a deal with myself. I said, I know that you need to own some gold. You just need to own it. And I had this like just gut instinct that I needed to do it. And I said, when you reach a point where you'll know that you've got enough Bitcoin. And what I now know what that is, it's Hodl talks about this as the BitLife crisis. In Australia, $1,000 doesn't buy you 1 million sats. It's really sad to see how many sats you buy with a meaningful chunk of your paycheck these days. That to me was a BitLife crisis, where you realize, oh man, like I'm buying hundreds of thousands of Satoshis now. You can't buy 1 million sats easily. You can't buy 10 million sats easily. And I look at my own journey, and like I was able to buy 1 million sats or 10 million sats at points in time in my life, but my salary was way lower. I was like a junior engineer, right? So you're dealing with a terrible salary, but you can buy more corn. And then as my salary grows, as everybody does, as you go further on in your career, you can buy more with dollars, but the sats are worth more. So like you're always kind of chasing your tail. And eventually I just realized now is the time for me to buy the gold. And I ended up doing, I think it was about maybe 18 months ago, 24 months ago, I really started my precious metals accumulation. And the idea was I want to have that liquidity buffer for exactly environments like we're in right now. And I always wanted to have a 90-10 split, just again, gut feel. And I could never get it to 90. I could never get it to 10% because Bitcoin kept running. Every time it went up, I was like, oh man, now I have to buy more gold. I can't ever buy the Bitcoin because I'm like chasing this 10%. Finally, Bitcoin pulls back and I hit my 90-10. So I'm like, okay, great. It did the job. But I know what's going to happen is Bitcoin's going to keep moving. But I think by having that diversification, it gives me that buffer. If something happened, I do not have to tap my Bitcoin reserve. I can tap my gold reserve, which is just going to be much less volatile. And that is what I'm essentially buying it and holding it to do.
What do you think about Stretch as a cash reserve?
Yes. So actually, us as a business, we've just taken a position in Stretch. I wrote a piece on this yesterday. I think it's fascinating. So just to give people a bit of a summary, Stretch is, I think it's not their latest, but one of their latest preferreds from Strategy. And the idea is it's the only one that's a variable rate. And it's basically going after monthly term deposits or money market funds. Right, they've been slowly ratcheting up the interest rate because the target is for this thing to stay at $100 US dollars. So they want this thing to trade at $100. And the idea is that people should be able to come in and out of it like a cash equivalent. It's basically a T-bill, a treasury bill, like a 1-month bill, but from Strategy rather than the US government, pays 11% rather than 3.6%. Now, I'm of the view that we are in a rate cutting cycle, but I think that rates continue to come down. I think the administration in the US and, I think the central bankers all want the rates to come down because it just creates stress over time. So as rates come down, that risk-free rate versus an 11% starts to look very, very attractive. Now, for us as a business, we've essentially acquired a couple of months of our salary in STRC because it's just going to sit there as a cash reserve, earning that 11%, so that if we ever get a big tax bill, or if we ever get, we get some horrible Bitcoin bear winter where suddenly it's hard to come by income, we've got a couple of months' salary as like a buffer. It's just going to sit there and generate 11% coupon. So I think it's a very interesting product. I think it's got a very, very large total addressable market. I mean, there's several trillion dollars worth in the money markets. It will not happen quickly. It will take a long time for people to kind of click to it, and Bitcoiners will go first. A lot of my clients in our Orange plan, they're retirees or professional investors, people who like high net worth individuals. The amount of times I've had conversations where Strategies preferreds have come up, and Stretch in particular, because it is that 11%. I can sit it there, and if I've got a large pool of wealth, I can put a chunk of it there, earn a salary effectively, and then let the rest of my assets run. So I know it's an attractive product. The fact that it's got back to $100 and it's staying there by design. So now I think 11% is the rate that the market is willing to finance Saylor's purchases. And in my piece yesterday, I was like, okay, well, basically the arbitrage that Strategy is doing, as long as Bitcoin appreciates more than 11% a year over the long arc of time, then basically they're arbing that difference. And I just did some very, very rough calculations of like, if you give Bitcoin a 10% CAGR or a 20%, 30%, 50%, what does it look like? And with a 10% CAGR, in 10 years, Bitcoin will be as big as silver and Nvidia are today. And I'm like, can Bitcoin do that in 10 years? I'm like, of course, imagine betting against that. And then you put like a 20% CAGR on, and suddenly it's getting up to like gold in 2020. Can Bitcoin get to where gold was in 2020 over the next 10 years? I'm like, imagine betting against that. And it's only when you get up to like a CAGR of 50% that you're like, okay, Bitcoin's bigger than global GDP. I'm like, okay, that might be a bit of a stretch target. So really, if he's financing at 11% and 10% just gets us to silver in 10 years time, like I'm pretty sure the CAGR is going to be higher than that. I think Bitcoin's a far more valuable asset than that. So my view is that that's probably a clever arbitrage. So the market has now been saying, yes, we're willing to finance your Bitcoin purchase at 11%. There's a huge amount of money that will over time start coming into that type of a product. And that means that strategy can really start their accumulation engine again. And again, they're not the only buyer, but they're a meaningful one. At times, they're on par with the ETFs in terms of the buy side capacity. So really, the ETFs and strategy I view as two easy to track large buyers. There's then the rest of the spot market, but I think the demand from both of those two is likely to be fairly healthy moving forward.
It's crazy what's going on. Like the preferreds weren't on my radar at all till I had time of like a Miami flight of 10 hours, and I was like, oh, like what can I research? And then I was like, oh yeah, let's download the last free strategy earnings calls and like some videos from some people that I trust in the space. And I was like, came out of the flight after 10 hours and I was like, how can I not like? How did I not see that last year, the whole year? It's really fascinating actually with the arbitrage, and I'm actually curious with the CAGR, because there's a lot of discussion like, what is a realistic CAGR of Bitcoin? I mean, the last 10 years has been like, I don't know, 60, 70% CAGR, but the last 10 years, I don't think is realistic to just like, okay, last 10 years we had like 60, 70, next 10 years will be 60, 70, just because like we have been so much bigger now than like we started 10 years ago. Yep. Now, having a 60% CAGR is just like absurd amount of huge numbers that are, I think, not even possible. But then you look at like maybe 20 or 30%, and you're like getting the realistic realm of like what you could possibly like expect from a CAGR. How do you look at the CAGR for like the next 10, 20 years?
Yeah, I think this is a little bit of a trap that I think people get caught up in when they're measuring CAGR. So I've got a chart on my website that shows it over like 1 year, 2 year, 4 year, 6 year, 5 year, like all the different spreads. And they vary wildly because the way that compound annual growth rate is measured, and for folks who aren't familiar with what this means, is basically saying if you have an asset, here's your starting point at whatever price it was and whatever date. Here we are 5 years later. What is the percent gain if you just take a long average? It's gone up at like 15% every single year, but it's compounding. So the first 15% then gets compounded by another 15%. So it's basically taking what is the profile between start date A, start price A, and where we currently are. How much does it change as a linear percentage? Now, the problem with that is if you measure the starting point at the top of a bull or at the bottom of a bear, and you measure your end point at the top of a bull, at the bottom of a bear, any combination of those, your CAGR just it's all over the place. So there are, look, you can measure it in various different ways, but my approach and what I did with the report yesterday, just go, well, as a Bitcoiner and as a gold holder, I can now look at Bitcoin and say, well, fundamentally, are we a $5 trillion asset? And I think I struggle to find a reason why we will not get to some kind of a price of that magnitude. And I'm not talking about in 10 years' time. Like, I think Bitcoin belongs substantially higher because as a gold holder and as a Bitcoin holder, I can tell you Bitcoin's better in every single way. It is just better in every single way. So I know that it is a more than a 10x improvement on the legacy system, which is gold. And I think that the market is slowly but surely, gradually going to work this out as it has been, which is why Peter Schiff has had 1 year out of 17 where he's felt really, really good. Silver's ripping through the roof. I mean, silver bugs have grown silver hair waiting for this move. This is like their whole life. They've been getting slaughtered by the price, and they finally get a run. Let them have it. So Bitcoin's been doing this for pretty much its entire life, consistently top of the charts in terms of best performing assets. So my view on CAGR is just like, I ran the numbers. Let's look at it 10%. Let's look at it 15, 20, and just eyeball how big would it be at the end of a 10-year period? What asset can I compare that to on a relative scale? Does it make sense for Bitcoin to reach that kind of a level? And I just use that and like, really, I get up to like 25, 30%. And only then you start creeping into like, when you get to 50%, you're like global GDP, it's like, okay, that's probably a little bit of a stretch. So 50% CAGR is probably a bit heavy, but it's definitely not 10%, at least in my view, right? From my perspective, 10% is way too low. 15%, 20%, 25%, it's like, that makes sense. Makes a lot of sense. Like getting to where gold is now over the next 10 years, like I literally said, I put a box down the bottom and said, my opinion, imagine betting against that as a possibility. So that's where I sit. I just think of it from a more fundamental standpoint.
The first thing that every Bitcoiner does, and the most important activity that every Bitcoiner keeps on doing, is buying Bitcoin. And I personally use Relai to buy and sometimes also spend or sell my Bitcoin. And there are two main reasons why I do so. The first one is it's Bitcoin only. They do not do any shit coins. They do not do any cryptos, any stocks, or anything else. This is a tool, an app that is fully focused only and solely on Bitcoin. The second one is self-custody. They give you the keys to your Bitcoin the moment you buy them. You never give them the control over your Bitcoin, and you don't have to trust them because you can verify that you and only you have the keys to your Bitcoin. There's no third-party risk. There's no freezing of your assets. There's no rug pulling. There's nothing of that. Download Relai, the app, on your phone, or go to relay.app on your browser and use code Robin to save fees and get cheaper Bitcoin. I want to tell you about something very special to me. It's called Microseed. If you hold your Bitcoin in self-custody, and you should, you know how critical it is to secure your seed phrase. You should not have them on paper. You should not have them on anything else than titanium. With Microseed, you can engrave your 12 or 24 word seed phrase, the entire seed phrase, onto a 1-inch small washer. Yes, just one washer. All 24 words on that one washer. You can hide that thing everywhere. And even better, you don't need to buy a new kit every time you have to get a new wallet. You can make unlimited backups because Microseed is not selling the washer. Microseed is selling the device that stamps the washer. So you get the full kit with the device, with the washers, with the hammer, with everything you need to get started today, and you can make with that unlimited amount of backups. Go now to microseed.io. 100%. I would be highly surprised if by 2035 gold would be substantially bigger than Bitcoin. Like, that would surprise me like really bigly.
Well, my base case is the gold will be bigger than Bitcoin in 10 years' time. That's just because that is the current status quo. So my assumption is, and again, I'm trying to be a bit conservative because that's my job. My view is that gold will be bigger. It'll be bigger than where it is now, in my opinion, because like the sovereign debt crisis is not going away. It's going to get worse. So I think gold's going to be much bigger. So I'm like, all right, let's benchmark Bitcoin. Can Bitcoin get to where gold is in 2020 or in 2025? Like, can it just get to where gold is now? Gold's going to go and do its thing, and then Bitcoin needs to just like catch up. For me, from a conservative standpoint, I'm not going to say like, well, gold's also going to be up here, so therefore it's going to be bigger than that. Then you start talking about real exponentials. But I'm like, can we just get to gold today? Because if we get to gold today, every single Bitcoiner will be extremely happy because we're coming from a $2 trillion base, which in the grand scheme of things, like, it's big relative to where Bitcoin's been in its past, but it's small relative to the pool of capital that is out there and the size of assets.
Yeah, it's like that's why Bitcoin makes a lot of fun, because like even the conservative view on Bitcoin is like, yeah, it's still like really good.
Correct. Yeah, totally. And honestly, that is the energy. What you just said right there, that is the energy that I think Bitcoiners need to adopt and take into this next couple of years. Even if we get a conservative target for where Bitcoin is going, it's going to kick ass. So like that is really, in my view, the real energy we should be going into it with.
I have this, I don't know if it's unpopular, but like this view that if you're not happy with like whatever 15 or 20% CAGR over a long period of time, you don't have a savings problem, you have an income problem. It's probably not the savings technology. I want to talk about strategy also, because I literally 2 days ago, old friend of mine was here. He isn't that big into Bitcoin, but I told him like, oh, I'm researching strategy now, and he was like, oh, what is strategy? And I was kind of giving him like a very simplified version of like how I look at strategy right now. And he's like, oh wait, so they are doing the same thing as like central banks did with gold? And I was like, kinda. Is that like a reasonable assumption that like strategy could be even like a central cyberspace company?
Yeah, I mean, there are a lot of parallels. And what I find interesting about strategy is there's a lot of parallels. You get like 20%. So it's like 20% like a central bank. When I think about stretch, It's a variable rate coupon yielding perpetual bond. It's kind of a bond. And the idea is that they can ratchet the interest rate up and down to generate demand or drop demand for it, right? And then what do they do with that? They go and acquire assets with it. So part of that, having a variable rate interest rate that a lot of people are going to be exposed to, there's a bit central banky. They've got an asset pool being Bitcoin, but that's about the 20% where it makes sense. And then suddenly the correlation breaks down. You can look at all sorts of different business models. You're like, it's kind of a bit of this and it's a bit of that. It's a very interesting system. Strategy continues to be it's something that I've gone in and out of it, just trying to get my head around. I'm very much an advocate for, in markets, when you put money on the line, you then go and study it at a much greater rate. So I find that you've got to put some capital in to just work it out. I sold mine at $300 back in mid-October, because I started seeing some red warning signs just across the broader market. Strategy was my risk position, and my thesis that it was going to run harder than Bitcoin as we went to all-time high. It just didn't play out. So I was like, my thesis is wrong. I need to exit, step back, and watch it. And I've been watching it ever since. And I've since rebought about half of my position down $158 or $160. That was my, I think, because it was down at 1x MNAV. I just seeing what they're doing, these preferreds. I'm like, there is demand for their product. And in my view, one of my big long-term views for treasury companies in general, the treasury is not the product. And I think this is where a lot of investors and probably even treasury companies get it wrong. They think that just owning a boatload of Bitcoin is the answer, but I don't think that is the answer at all. The answer is the means by which you accumulate. So for Strategy, for example, their product is these preferreds, which are basically, they never have to refinance bonds that pay a very healthy coupon, 3 times larger than the risk-free rate in Stretch's case. Is there demand for an asset that stays at $100, pays an 11% coupon in a world where the money market risk-free rate is 3.5% and probably going down? Yes. The market loves yield, and something like that has a huge total addressable market. So Strategy has a product that I'm very confident the market has a lot of demand for. What happens when a company hits product market fit? They produce a lot more of the product. So they're going to sell a ton of this stuff because there is demand for it. And what do when they sell a ton of this stuff? They buy Bitcoin. And here's the trade that they're really doing. If we believe Bitcoin's going to monetize the way that we've been talking about, it's going to continue to trend higher at more than the coupon rate that they're currently issuing at, then the base case is that the obligations that they have to pay every year, they've got to pay 11%. It's going out the door. That's like the leakage that's coming out in coupons. Will that leakage, let's imagine they stop selling preferreds and they just sit there and wait. Eventually, Bitcoin's going to be higher, and suddenly the amount of outflows will get much, much smaller. Their obligations will shrink relative to the Bitcoin that they hold. So for me as a shareholder, that's accretive, because now the balance sheet gets the equity that's left over once they clear all of their debts and obligations. That is ultimately what shares are. It's the equity in the business after you've cleared all of your debts and obligations. Suddenly the equity is worth a whole lot more, right? Because they've got that leverage component as Bitcoin gets bigger. So I'm actually of the view, and I wrote a piece recently talking about why I took my position. Even though they're diluting right now at an MNAV of 1, they did the USD reserve, which I think built a whole lot of trust that they're going to pay the dividends, which means people are going to buy the bonds or the preferreds. Because people are going to buy the preferreds, it means they can sell more of them. I'm actually okay as a shareholder being diluted at 1x MNAV. And this is something I think a lot of people probably haven't quite, and I could be wrong, but this is my opinion. If I buy Strategy when it's an MNAV of 3, I'm buying 33 cents of Bitcoin and 67 cents worth of premium, right? I'm buying a lot more premium. And my expectation is that premium has to get bigger. But if I'm buying Strategy at a 1x MNAV and they're using the proceeds to buy Bitcoin, and I believe that unless Strategy goes bankrupt, at an MNAV of 1, it's more or less trading like an ETF. So and again, this is purely a price exposure perspective. When I'm buying Strategy as a shareholder, an MNAV of 1, I'm buying all the history, all the Bitcoin they've already bought, all the infrastructure they've already laid. I'm buying all of that history. So really, I'm actually buying my dollar value worth of Bitcoin in that business with all the infrastructure attached to it. If I'm buying it at a 3x premium, then I'm getting 33 cents worth of Bitcoin. So the way that I think about it as a shareholder, I actually don't mind when they dilute me at 1x MNAV, because it's building more of that base that when it starts moving higher, Bitcoin starts moving higher, suddenly they can sell a ton more of these stocks. And I want some other dude to pay the premium down the road because they get caught up in the euphoria, and I will be selling to them. So that's ultimately the way that I think about it. I actually don't mind being diluted at 1x MNAV because it's kind of like me buying an ETF for Bitcoin in terms of price exposure. And I do view strategy as my risk position, right? As all Bitcoiners, like I love having self-custody Bitcoin as my primary holding, but also I kind of want an asset that I just want to trade and like hold it for a shorter period of time and just ride the waves, because I hate selling Bitcoin, but I wouldn't bat an eyelid if I was going to sell my strategy. So for me, it's a risk position that I've been in this market long enough that I'm like, I think I have an edge by just thinking through these problems. I'm going to ride this wave, and in my view, I think it's going to outperform BTC on the way up. I'm not looking for 50x multiples. I'm not looking for some penny stock treasury company. Like for me, I kind of just want a bit of a multiple, and I also think the business model they're doing, it's a company that sells a product that I know there's a lot of demand for, that I think is going to have a lot more demand in the future. So it's a real value investor type approach from my view.
Yeah, it's like at a premium of like 6% or 5%, like it almost seems ridiculously cheap. Like if the whole thing works out, like always like with strategies, like if the execution is good and Bitcoin is good, like at a premium of like 6%, like that's premium of 6% means 1.06 MNAV for people. But like that, like the more I look at it, I'm like, oh, like those levels look super juicy.
Correct. Yeah, no, totally. And you know, are they going to go into an MNAV of like 0.5? I don't think so. They did in 2022, but like I look at the infrastructure they've got now, and most importantly, Bitcoin is in a downtrend. And one of my longest standing challenges for strategy is they've never been able to buy in a downturn until now. Now they are buying in a downturn. They seem to have, and as you would, right? I mean, imagine the compute cycles that Saylor's been through in this journey, being down however many $1 billion they were in 2022. You just think about this stuff a lot. How do we adapt for the next bear? And in my view, they've now switched into what looks like not quite daily, but a daily DCA type model, weekly or bi-weekly. And I've run plenty of models trying to understand, like, how can you out trade Bitcoin? And honestly, unless you're really in the weeds trying to play with, like, you know, algorithms and all this type of stuff, daily DCA is one of the hardest strategies to beat. It's just so unbelievably difficult to beat. For the average person, really, I don't know why you do anything else. Lump sum, obviously, at the perfectly right time beats it, but that's its own skill, because like some people will be waiting for the bottom and they won't be invested at all. Then the market will run. And if you miss some of the best days in a Bitcoin cycle, I ran this study as well. If you miss the 10 best days, and of course, this is not a perfect model, but I just set all the 10 best green candles to zero, you're actually down, or sometimes you lose money on the Bitcoin cycle. So those 10 days make up for all the chop, all the down, all the bear, the whole lot. 10 days make up for it. And why do people trade? They want to miss the 10 worst days. If you miss the 10 worst days, your return from a cycle goes from like a 10x to like a 15x or a 20x. So yeah, you get twice the performance, but you're risking getting a zero, right? So you're risking the whole 10x just to get that extra 2x worth of juice. And daily DCA is just hard to beat. And when the company started switching to what kind of looks like almost a daily DCA, that's an unbeatable strategy.
Now, if someone, like most people have like one job and they like get maybe one salary, maybe a second one, so they get paid depending on where you live now, but like in Europe, maybe monthly, in like America, maybe bi-weekly, so like twice a month. So you say daily DCA, is it better to just like when you get money in and you know this is the money that you don't need, the savings rate, basically just like put it in there on the day you get it, or spread it actually out through like the whole month of like making, instead of instead of like $300 in the beginning of the month, like 30 smaller buys? Like, okay, you take so management is then also a whole thing you have to witness, but you have to exchange. But how do you look at, like, if someone gets paid once a month, how they should think about deploying it monthly versus like maybe bi-weekly or like weekly or like daily even?
Yeah. Yeah, I mean, it totally depends because, I mean, it depends on your goals. Like for some people, again, there's different extremes here, right? I've definitely gone through the money in or gone, right? I went through a whole many years where I was like, money in, pay bills, everything else, like literally 20 minutes after I've got my paycheck, there's nothing in my bank account. It's just all gone into Bitcoin. That was my life for many years. So I've been through that journey. Nowadays, I just have a daily DCA that's just plugging away, and I basically wait for downturns. And so I kind of do like strategic daily DCA. When the market was up above like 110K, I didn't have daily DCA on because I just thought it was a bit expensive, relatively speaking. And my view is I would rather save that capital and just have it building up so I can turn on a heavier daily DCA when the market's looking down. But that is also, it depends where you are in your journey. I've been in the market for a number of years, so I'm not building my initial position. I already have a Bitcoin position. So for me, I'm not that fussed if I don't buy more sats all the time. It doesn't phase me that much. What I want to do is buy as much when it's cheap. So for me, that's kind of my strategy. But if you do it on a monthly basis, basically you kind of miss all the volatility within the month, and it kind of depends when you buy. And as we know, you like in the short term, markets are unpredictable, and I think it's nonsense people trying to predict stuff in the immediate short term. So if you do like monthly, you're basically saying like the rest of the month, I'm not going to see any of that price action. But if you're doing it on a weekly basis, the shorter your resolution, like in theory, the most average price ever is a 1 second DCA, but like sometimes it becomes impractical. So honestly, I think daily, weekly is fine. Like again, we're talking about small digit percentage points in terms of delta here. I like daily DCA because I don't have to think about it ever. It's either on or it's off. And that's my mode. It's either on or it's off. And I just keep topping it up all the time. So that's the way that I like to think about it. When Bitcoin is undervalued, I turn on the daily DCA. I have it just chugging away because then I can focus on my life. And I've found as a professional Bitcoin analyst, right? This is literally what I do for a living. And people are like, oh, do you trade off this stuff? Like, no, I don't trade off it. You know why? Because I hate trading. I can do it and I'm decent at it, but I hate it. It's such a toxic thing for the mind. And I noticed this in my own like experience. My net worth is fluctuating with the Bitcoin price. Like I don't think about it ever. I never think about it. I couldn't even tell you what it's worth because I never check it. But if I put $100 perpetual trade on and I'm like down $30 because it's a red candle, I'm looking at it all day being like, oh man, this is like it takes up my brain power. I'm like, I hate it. I absolutely hate it. I would much rather analyze what I just see as a very, very big and interesting puzzle. I just like analyzing the market because that's what I love doing. I love taking all the data and trying to understand where investors are doing, what a future is doing versus ETFs versus Onchain. That I find interesting. Sitting there trying to like make levered trades and like play these things, I just don't care. So for me, daily DCA helps me do what I love to do, which is analyze the market, try and develop a confident picture for what's going on. That's challenging enough. The last thing I need to be doing is trying to manage a perpetual swap on the other side, because in my view, that detracts from my product, which is analysis. All right. And if I'm distracted with some $30 trade, to me, that kind of degrades the whole experience.
I think trading only makes sense if you don't have something better to do. And you should have something better to do. like that's always the point for me.
Yep. And I went through a phase because I was living in London when I first discovered Bitcoin in 2019 into 2020. And at that time, I was learning how to trade and studying options and futures and all this type of stuff. And I had accounts everywhere. And you have to and this was my sign that I'm not a trader. You have to have like a journal where you're tracking all of your trades, going back and studying. Did you have an exit plan? Did you have an entry plan? Did you cut your losses at the right time? And you need to see where you're making mistakes. It's like a sport. If you don't go back and study, when I'm playing tennis, it's always my second serves that I'm losing steam on, or I'm hitting the net every time I first serve. If you don't go and improve your first serve, you will continue to lose. So you have to have a journal where you're tracking this stuff to understand it. Now, I wrote myself in, because I was an engineer at the time and I love using spreadsheets. I wrote myself like 20 journals, right? Different formats of making sure I'd capture all the information. And I probably only ever filled in 2 rows because I just lost interest in filling in the journal. So I've made more journals than I have entries in any of the journals. So I'm like, that tells me that I actually don't care for this this science. It's just not something that interests me. It's so much work and so much energy. And I'm trying to design tunnels at the time. I'm trying to design mines. I've got a job that I'm trying to deal with. And I come home, the last thing I want to be doing is like studying my trading journal. And like, I just don't care. I just don't care. So that was my kind of trigger point to say, actually, you know what? I don't care, but I loved analyzing it. Right? I love the process of thinking through markets, understanding strategy, understanding the ETFs, understanding the on-chain data, piecing all that together. I find fascinating. That's the engineering side of it. Filling in a journal of entries, exits, stop loss. No, someone else's job.
I very much agree with that. I love that. By the way, I also want to note that because you said it earlier, that when you research something, you want to have like a foot in the door. So like you deploy some money to actually research. I do it all the time. I love that you mentioned that, because I think it's an underrated strategy. I tell this to people also that want to get into Bitcoin. Just buy some. Like if you have on the bank account like $500 laying around, just buy some Bitcoin and you will actually get your ass off the couch and you will actually learn about it. The first time I want to do research strategy, I just bought 5 stocks. I was like, oh, let's see. Like I just like I want to buy it. And then the second day I was like researching like crazy. Like nothing changed. All of a sudden there's a motivation. Like it's a total game changer. Like if you want to research something, if it's so interesting that you want to deploy like 10, 20, 30 hours of research, maybe hundreds of hours of research, like before you research, deploy like $100, $500, $1,000, whatever is small money for you. If could build a 10K.
Absolutely.
I want to talk about
and just to that point, you basically need to buy enough that it's not going to bankrupt you. You're not going to, like, if it goes to zero, you don't care. But it needs to be enough that if it goes down, you're going to go, I want to understand why. Like it needs to have enough of like a pain point where you're like, okay, that was interesting. Let me study more. Why did that happen? And then you start going down the rabbit hole. So it needs to be just big enough where it hurts if it goes down, but not enough that you care. So it's in that kind of realm. And, one thing you learn as an investor, I mean, obviously as a trader, but certainly as an investor, and I've certainly hit this point, there's assets that I know that I want to buy. And when I put that position on, I do not care about losses. I think you have to actually get used to the fact that, I mean, how often do you buy something and it immediately just goes up and you pick the absolute peak bottom? It just never happens. So you get used to the fact that I'm going to buy this thing. I'm going to wake up tomorrow and it's going to be down 5%. And I need to not care, because that is an important part of investing, accepting losses and accepting that they come around, and you will get some losers. That just will happen, but you've got to be comfortable with it before you step in.
I wanted to buy strategy Friday evening, but I couldn't because the money didn't clear to the exchange. And so I was like so angry. I was like, I really wanted to buy it, but I was like, okay, I'm in Europe, so I can actually buy strategy now on Monday, Martin Luther King Day. And then I was like, oh, hey, I get like 5%, like, or 2%, like a small percentage, like off the strategy. And I was like, oh, I'm really happy. Like the money didn't clear. I bought it like a few hours later, it's down even more. Like it always happens. You buy it, like it goes down. So
and that's like actually that reminds me of another key point. It's just a classic market psychology. When you go to buy something, if you feel like that level of like rush, go for a walk. Go for a walk. Don't do it. Because if you feel super excited to buy something, very rarely is it the right time to buy. If you're going to buy it and you're like sitting there over the green button being like, I don't know, man. I don't know if I want to do this. Like, but what if it goes down? If you like, your stomach is churning, and this applies in selling as well. If it's ripping to the upside and you're like, I can't, man, I don't want to sell this thing, like press on, do it, commit, go through it. You've made the decision, go through it. If it feels terrible to make a buy or a sell decision, it's more often than not, it's your body's way of saying, I don't want to lose money. But that's usually when everyone else is going, get me out, man. And that's like, it's the bottom, generally speaking, local or global. But look at your own feelings. If you feel excited and euphoria on the buy or the sell, go for a walk. If you feel like your stomach is churning, press on, commit, go for it.
I have a very bad comparison now. Maybe as a YouTuber, I'm trained differently because there are videos where I record it. I know, wow, that like has been really good. And then title and thumbnail, that is like a perfect sitting one. And I have that feeling that it like really will rip. And I was like, this will be a great video. And those are the videos where I'm like, I want to release it right now. Like, I can't wait anymore. And actually, like, this feeling usually is right. Because like, oh, like I know the audience. I know, like, I have so much data. Like, I put out like over 700 podcasts. At some point, you get the feeling if something will go good or not go good. But I guess if trading, it's like the opposite around, where you have to like if it's ripping, maybe you shouldn't do it at that very time. The most important thing for your Bitcoin journey is not buying Bitcoin, but it's how to keep them. And yes, you have maybe the right tools, but how do you actually go ahead and stick it all together so it's the most secure for you personally? Self-custody is a deeply personalized journey, and the Bitcoin way is helping you exactly finding that correct setup for you personally. They are also helping you with securing your own cybersecurity. And if you want to go one step above all that, you can even get a consultation for a Plan B residency. Go to thebitcoinway.com/Robin and you will get a 30-minute free consultation. I finally and officially mine Bitcoin. This is not just something to stack more Satoshis, but it's most importantly also to support the network. Individual miners are the ones that keep the Bitcoin network decentralized. And by the way, you get KYC free Bitcoin. That's why I use Simple Mining. I get an actual proper Bitcoin miner. They set it up for me. They repair it if it breaks down. And most importantly, they let me choose the pool and even connect my own full node. I'm completely sovereign and I'm completely in control, and I can sign up with Ocean, no account needed. I just give them a Bitcoin address and then there's mining going on. No KYC, nothing. So if you're ready to mine Bitcoin, go to simplemining.io, tell them you come from Robin, and let's mine Bitcoin together.
Markets are extremely counterintuitive, and a lot of CEOs come into markets thinking that because they've mastered business, that they can master markets, and it's a very humbling experience. Markets always do this. They move in the opposite direction. So, and this is actually true. I find it in business as well. Business and markets are the two areas where common wisdom, generally speaking, is wrong. You know, how many times have you read, if you've read books about like, how Jeff Bezos, for example, he's got all these like adages of how to successfully run a business. Your first gut instinct is very, very rarely correct. As a good example, if you're like building a company, a lot of people default to building it for them. And that some companies are extremely successful from that front. But if you take that too far and you don't build for your customers and you keep building for you, you actually end up ignoring the people who actually want your product. So you're building for yourself, not for other people. And sometimes it works to build for yourself. There's a lot of good stories there. But common wisdom is you've got to listen to your customers. And sometimes your customers want something that you haven't thought of. And you've got to kind of, construct that idea. Same in markets. If you're feeling really good about something, it's probably the wrong thing to do. And this is actually why I love on-chain data, because you get to see all of the people who are smart and dumb. The smart money will wait, and they will wait, and they will wait, and they will sell at 100K all at the same time. And the folks on Twitter are going, why would anybody sell? It doesn't make any sense. I wouldn't sell here. It's like, that doesn't mean people aren't selling. And then what happens is all the people who buy up at those high prices, they wait and wait and wait in the downtrend because they think it's coming back. And they all capitulate at the same time. You get one red candle and everyone just goes, I'm done. I'm chucking in the toys. I've had enough. I'm out of this thing. I'm down 40%, 50%. I'm quitting. And that's usually the bottom. So you can actually look for when people are selling at the right time and then when those people who bought capitulate all at the same time. And it all happens on the same day. FTX, perfect example. When 3 Arrows blew up, perfect example. Everyone sold at the exact same time. On the same red candle, they capitulated, and you're like, that's crowd mentality, going the opposite direction.
I have an interesting one. You know probably Fernando Nikolic from the Bitcoin Perception. Mm-hmm. And he brought it up because I asked him, he is monitoring Twitter and also Reddit, and he found that interesting observation that Twitter gets more bullish on Bitcoin when the price goes up, and Reddit is the other way around. Reddit is getting more bullish on, gets more bearish when Bitcoin price goes up. I found that really hilarious because I don't like, very rarely on Reddit actually, but like probably people are thinking deeper, like they're getting more excited if there's like a discount or something like that, which I find really fascinating. Twitter doesn't surprise me.
Yeah, and it's the different incentive models, right? It takes time to write a Reddit post, whereas Twitter, you just, shoot it out left, right, and center.
100%. One thing to this, to the whole treasury company space, and you also mentioned like BlackRock and ETFs. How do they actually change Bitcoin, if at all? Like there's like now we have this era almost from plebs buying in 2013, and now like the institution seems to get a bigger portion, and like the bias seems to be getting to be a different size and a different like mentality. Also, like the strategy is buying a different mentality than like Joe from next door.
Mm-hmm. Yeah, totally. So I think that's a big, I labeled a lot of 2025, I call it the great rotation. We have seen a significant shift in the investor base, whether it's the IPO moment, as you want, the way you want to like frame it up, but a lot of people who have been spot Bitcoin self-custody from the early days, they've rotated. And by the way, a lot of these guys aren't selling everything. They're just selling a chunk of their stack, right? They're migrating some of it out because they don't want to take the full-blown risk and be glued to the Bitcoin price forever. So you got a rotation of like, I'm going to call it the Wild West Bitcoiners, the guys who got it from zero to something. And we're getting a lot more of these institutions, ETFs. There's some capital that's going to rotate from just like hodlers into ETFs. A lot of people like to say that that's the only thing that's going on. It's certainly not. The ETFs are nowhere near big enough to account for the sell side. But institutions starting to come in. I mean, if you just look at the news, I mean, Saylor talks about this. You look at all the news that's happened in terms of like banks starting to allow it as they're custodying it, they're using as collateral, and the ETFs are increasingly accepted. Morgan Stanley finally steps in and goes, we want to have not only just like an ETF under someone else's name, we want a Morgan Stanley labeled ETF for Bitcoin 2 years after they've gone live. So there's all these like big components that are changing the holder base, changing the investor base. Once Bitcoin gets allocated as like a 0.5%, a 1%, a 2%, a 5% part in just like people's portfolio, a lot of people won't know that they own it. It's just going to be part of their like investment mandate, and they'll be rebalanced by their financial planners. So there's a whole pool of investors here. I think the ETFs actually a really good case study for this. Price went down 35% from the all-time high. Pretty meaningful drop, not the worst we've seen, but meaningful. The outflows from the ETFs, you can look at it from two different ways. One is the total Bitcoin that flowed in, so the AUM. How many Bitcoin that went in came out? It was about 3 to 4% at the worst case. So 35% drawdown and 3 to 4% of the AUM came out. That doesn't look like orange poker chip. I just want to play the casino type money. That's like most people are hodlers. And if you can also look at it from like the cumulative inflows, how many dollars went in and dollars came out? We peaked at like 63.1 billion of total inflows. It came down to like 58 billion. It's like 7% or an 8% outflow. So again, 35% down, 8% of the dollars came out. 3.5% of the Bitcoin came out, which by the way, if you think about those two numbers, 8% of the dollars came out, but that was only 3.5% of the Bitcoin because the Bitcoin price has gone up. The people who bought in 2024 are very happy. They're up. They're meaningfully up. So in many ways, I think the ETFs are a good snapshot that they're actually just hodlers. A lot of people who are buying this thing, they're not trading the price. They're buying, they're sticking to their portfolio. It's a part of a thing that they've probably wanted to own for a long time, or their financial planner said, look, it's a good diversifier. It's a good this, it's good that. And they just put it in there as part of a portfolio construction. So that actually changes the way that people think, behave, trade, and over time, that will only increase, right? If you think about what strategy is doing, they're taking Bitcoin and they're converting it into these credit products. The people are happy to buy the credit products, and strategy's happy to hold the Bitcoin. Like in many ways, it's kind of creating that buy side by these credit products that just goes into a black hole and probably doesn't come out again. So yeah, I think there's a lot of shifts that go on, and it's why I'm a big advocate for, got to look at the on-chain, you got to look at the ETFs, you got to look at the futures, got to look at the options. You've got to combine all these market sectors because they all tell a story, and we're trying to piece together and say, where is the average marginal investor across all these different sectors?
Now, one more thing I really want to get in there, and I think I'm so deep into that like I'm almost getting annoyed by it, the 4-year cycle talk. Yes. But people seem to be really interested in it, and I had so many different opinions already in the podcast. I think just today or so, like when this is out, like 1-2 weeks later, we had a talk with Stephen Perrinot where he actually measured the tops, and he was like, okay, it's actually not a 4-year cycle. It's like sometimes a 3.5, sometimes a 2 years, sometimes like even a longer cycle. So there are people that just say like, oh, like there's not even a 4-year cycle. Then there are people it's dead. Now, like what is even a 4-year cycle? It's like the halving cycle. Is it like 3 years up, 1 year down? If we measure it like that, I guess it's dead. It's like 2005 was done.
Yep.
How do you look at that topic, and what is Bitcoin actually telling us on that?
So my longest, one of my longest views, I think I formed this in like 2023 for this cycle, is I didn't think the bull would be overly different to previous bulls, but I thought the bear would break people. I think the bear would be very different. And I think we're in that now, right? Again, it's an interesting type bear that we're in, because it is nowhere near the damage that we've seen in previous cycles, but there's still plenty of examples where it is bear market like. So let's just imagine, right, that we can run through a couple of scenarios here. If the market bottoms at 80K, it's already bottomed, and we start moving back to all-time high, are people going to reset their cycle chart and say that was the bear market and therefore 4-year cycle started again? Are people going to call it a super cycle, right? If we go back to all-time highs, which one is it? What happens if we go down to 60K or 50K, right? Which is, I think the target for the bears right now is about 56. That's 200-week moving average, realized price, there's a bunch of things down there. If we go down to 56K, and then suddenly next thing you know, like by, I don't know, October, we're back at all-time highs, are people going to reset their chart as if it was FTX or the 2018 bottom or COVID? Are they going to reset everything because it's like a 50% drawdown versus the 80s that we had in the past? The way I look at things is actually just based on supply and demand and sentiment. Because ultimately, what is a bear market? A bear market is a process of resetting investor expectations, clearing out all the euphoria from the bull, getting rid of all the tourists who didn't want to be here until you're left with only the highest conviction holders. Now, there's no measurable drawdown that has to be. There's a component of depth, how far it goes down. There's a component of time, how long it stays down there. There's going to be people who look at it and say it has to hit this technical model, but also we have 3 data points. We only have 3 data points to compare here. So there's a lot of folks who will say we went below the 50-week moving average, which means we have to go to the 200-week. Okay, but let's look at the previous cycles. What did it take? We go below the 50, but what needed to happen to take us to the 200-week? In 2017, we had all of the ICO blow off, and when we literally went up 100x from the bottom. It was a 100x move. When you look at the supply distribution, there were no long-term holders between like 6K and 20K. It was all people who bought in the last couple of months. It was such a euphoric rocket ship. Those people are just in for a quick buck. And we talked about this before. Only 20% of the sellers were long-term holders. Most people were there for a quick buck. There was a huge retail overhang that needed to be cleared out. And in 2018, the odds of Bitcoin succeeding were nowhere near where we are today. No, not even remotely close. In 2021, we needed Luna to market sell 80,000 Bitcoin and collapse as a fraud. We needed 3 Arrows Capital to borrow billions of dollars in unsecured credit and be a fraud. We needed the likes of Celsius and Genesis to be fraudulent lenders. We needed FTX to be selling Bitcoin they didn't have, and then also be like literally the largest fraud of all time. That's what it took. That's like a full, complete catastrophic clearing of everything that the market had built. All the lending infrastructure evaporated. What's the equivalent now to take us to the 200-week, aside from it did it in the past? So from my view, I think thinking about the 4-year cycle is going to throw people off. I actually don't think it's useful information. There's no doubt that people will have traded it. They will have gone, and you're right, the tops line up almost dead on. It's like 1,069 days, almost to the day, where all the previous cycles had topped out since the bottom or since the top, whatever you want to do. So yes, there's like a 4-year cycle cohort, but if we get this bear market that just doesn't have the same shape as previous ones, people are going to go, well, do I reset it? Do I not reset it? Where do I think about the bottom? Like, so the road moving forward will be increasingly confusing for people who try to anchor to the 4-year cycle. It's definitely not driven by the halving. It just, there's nowhere near. If you look at miners versus hodlers, like long-term holders selling, I have a lot of my charts on my website that shows sell side pressure. There's actually a hidden trace that I've got, which you can turn on, that's minor issuance. And you've got to zoom in, zoom in, zoom in, zoom in like 50 times. And then finally you see this tiny little squiggly line down the bottom. You're like, oh, that's the minor sell side versus like the rest of the, all the other sell side coming from hodlers. So it's just irrelevant. So the halving isn't driving it. Investor psychology will take time to adapt, but there is no asset anywhere that has a predictable X year cycle. There's just no reason for it to be a thing. So I think a lot of people believe it. I think it's going to be confusing and clouding your judgment if you hold on to that view. I actually don't think, I think you can explain every market cycle without needing a 4-year cycle framework by looking at it from liquidity pictures, by looking at it from what was going on in the world. 2019, what was 2019? It was the plus token Ponzi buying 2% of all the Bitcoin. What happened in 2021? Well, GBTC bought 660,000 Bitcoin because there was a premium. So like you don't actually need the 4-year cycle to explain what was going on in the supply and demand balance. So that's certainly how I think about it. It's going to be driven a lot more by just like macro factors, economic conditions, and just Bitcoiners buying this thing because they want to hold it. So I think there's a lot more dynamics internally and externally that do not require a 4-year cycle framework.
I love that, and I will take that as the final answer to what a what about the 4-year cycle? Clip it up and send it to whoever is asking. Last question: what do you expect for 2026 and the coming like months and years to come?
Yeah, so 2026 is an interesting one. I'm very much in the camp where no one can predict the future, and trying to is kind of futile. But I'm generally constructive. I like the overall things I'm seeing with the Bitcoin market. I'm not yet convinced that we've cleared like this bear hangover just yet. I mean, honestly, we've got to get back well above 6 figures and kind of stay there. As it stands right now, there's a ton of resistance above us. 98K is where the short-term cost basis is. And if you ratchet that up to like 105, as we were selling off, I used an analogy called the hodler's wall, where I looked at all of the supply. If you imagine like a bar chart that shows where people bought their coins, there was a massive chunk of supply above 95K. And when we got below 95, 75% of all the invested capital was underwater. So we've got to basically get through that on the other side, on the way higher. So there's a lot of people who've capitulated down to lower levels. I like the shape of the capitulation I'm seeing. We've gone from 70% of the market being underwater to 58% being in profit. So we've actually gone from like a super majority being underwater on their position at 90K. And we're now at a position where more than half are back in the money. So there's been a ton of top sellers who've sold. A ton of people have come in at 80K. But we haven't seen that like real bullish impulse and a resurgence of demand. Strategy looks like they're about to restart their engines with Stretch. ETFs look like they're starting to buy, but 1 week is not a trend yet. So overall, I like the setup, but I also think that there is a non-zero chance, there's a meaningful chance below 80K down to about 70 is a thing I called an air pocket. Basically, no coins have traded between 70 and 80K. So we've seen these air pockets in 2021, in 2017, at the start of 2025. Those air pockets just seem to want to attract the price. So I'm certainly keeping an open mind and saying, look, I don't believe we go below the 2024 chop consolidation zone. My base case thesis, I don't think we get to 56K, which is kind of the bear's current target. So I don't think we get there, but it's obviously possible. I would put like, I don't know, 10, 15% chance of getting down to 56K. My base case is we probably bottom somewhere in like the very high, like 68K or 70K. But the thing that would change my view there, if we go down to 70K at any point, we can't go down there and stay there. If we stay down there, then my thesis is wrong and we probably head down towards 56. If we sell down there, I'm going to be buying with 2 fists because I think we will probably get that capitulation wick that just flushes people out and people will just step back in. So I'm actually generally constructive. I think 2026 is actually shaping up to be a decent year. I think from a macro standpoint, there's a good case to be made that economies start to re-accelerate. We're seeing metals, like not precious metals, but industrial metals start moving higher, and people aren't stacking copper bars and iron bars. That's economic activity. So I think that the emerging markets are going to do much better than the US. I think basically markets outside the US will do much better. And that generally stimulates commodity demand. I think energy prices are probably too low. So I just think there's a bit of a re-acceleration of the economic conditions. And if that happens, generally speaking, Bitcoin's fairly well correlated with rising economic activity. So with all the geopolitics and everything else going on, it is going to be a rocky ride. It is not going to be clean, but I'm generally constructive. For Bitcoin, I think it's undervalued. If you just look at the what you call the alligator jaws, gold up, stocks up, silver up, metals up, everything up, Bitcoin down, Bitcoin's undervalued. Like in my view, this is why I'm a very, very happy stacker down here. It's why I've allocated half my strategy position. I'll be looking actively to take my second half when I get this like evidence that I think the market has bottomed. So I like what I see, but just stay frosty out there because I don't necessarily think we've kicked this bear just yet. We're working on it.
I love your takes. We have an end routine in the podcast, as you well know from the last time, where the previous guest is asking a question for the next guest without knowing who the next guest actually is. And the previous guest asked you, besides price, what is your biggest disappointment of Bitcoin in 2025?
Oh, that's an interesting one. Biggest disappointment. It's not quite... I'm a little bit disappointed at, I think I'm going to give you the answer and then I'm going to give you the counter answer to my own disappointment. I'm a little bit disappointed by the way that the treasury company trade played out. I think a lot of Bitcoiners really rushed in to both becoming a treasury company to capture that retail euphoria. And I do think there was grift. I think a lot of Bitcoin, I think it was Bitcoiner on Bitcoiner crime. I think there's a lot of Bitcoiners that came in, they paid themselves extremely healthy salaries and they kind of minced them. You know, like the investors, and I know that everyone who buys an asset, it's your decision, but a lot of people bought these things and got absolutely railroaded, you know, down 90%. And again, that's the investor's choice. They probably felt very euphoric. They didn't listen to our advice from earlier. Do not buy something when you feel euphoric. However, I also think there was a lot of Bitcoiners who jumped on the bandwagon. There will be treasury companies, and this is my kind of counter answer to my own disappointment. There will be treasury companies that become something. They actually do turn into a business and like buying at the low. It's why I'm buying strategy, right? At 3x multiple, not a good time to buy. At 1x multiple, much more interesting. So there will be treasury companies that solve a real world problem. But I'm still disappointed by how many of them I'm pretty sure were just an outright grift that kind of took people's money, paid themselves a very healthy salary, and really have no road to success. Like they just have no pathway. They're never going to be big enough. They don't have a team that's going to manage it. It was kind of Bitcoiner on Bitcoiner crime. So I was a little bit disappointed by that.
I'm wondering often if this is because I think there is like certain bubbles going on. If there's something popular coming in, there's a lot of copycats that try the same, but like they don't try it in the right way. Obviously, I think depending on how you define it, every company will be at some point somehow a Bitcoin treasury company, just because it will make sense for a company to hold Bitcoin on the treasury without issuing preferred stocks, or without issuing convertible notes or anything like that, just like holding on a treasury. But like those pure plays, and especially if we have like a huge successful like next 2-3 years maybe, where Strategy and MetaPlanet and Strive and other treasury companies are doing really big and really good, I'm wondering if this will actually encourage like a bigger copycat euphoria that we've seen even like last year, because I think like 200 companies could be a lot more. Like when we see the internet bubble, like in the 2000s, the .com bubble, like could be a lot more that like do this and like get burned and grift around.
Yeah, and it's very possible. And I think what I should certainly clarify, when I say treasury companies, our company is a treasury company. If you define it as like buying Bitcoin because that's our treasury asset, I do not consider us a treasury company. I just consider us a prudent investor. You know, like companies that have a business model, you know, they have a pizza shop or they write an analysis newsletter or whatever it is, and you're buying Bitcoin, that's fine. Not talking about you. I'm talking about the Saylor playbook all in, selling equity, selling debt, levering up. Like, your job is to buy the big, and this is where my previous point, the product is not owning the Bitcoin. The product is how you accumulate the Bitcoin. And if your only way of accumulating the Bitcoin is selling your own shares, you're a very unattractive company. Because and then there's like arguments of saying, oh, but then in the bear market, they can sell the Bitcoin to buy back their share. I'm like, so you're telling me that you're a company who buys Bitcoin at the top, waits until it gets to has a drawdown, and then you sell the Bitcoin to buy back your own failing company's stock? That sounds like the worst hedge fund of all time. Why would I ever want to own shares in that? So I think there's a lot of companies that mistook what Saylor was doing. Saylor and strategy is I use the word bond. They're not really bonds, but they're bond salesmen. They sell dividend yielding stocks. That's their product. The Bitcoin is the means to the end. It's a very powerful means to an end, but that's the means to the end. Having Bitcoin in your treasury is not the product. So yes, there probably will be a resurgence. There will be more grift. It's one of those fine lines where the gray zone is everything. There are companies that are going to be very successful and they're going to do this well. There are also companies that are just outright grifts, and I think we should be cognizant of that and not just say, oh, but all treasury companies are fair value, because some of them are just outright grifts. That's just a fact, and there will be more of them. And I think as Bitcoiners, the same way that for years we've been calling out shitcoins, we should just say, guys, this looks like a grift to me. Show me your pay packet. Oh, look, you're getting $10 million in the first year, and you've delivered nothing. Right? There's no stock-based compensation based on the performance of the business. It's just like, oh, you get a fat paycheck. That's a grift.
I love that and very much agreed with that. Thank you so much, James, for being on the podcast. And before I let you go, where can people find you, find a newsletter and all the things that you're doing?
Thanks, mate. Yeah, you'll find us over at checkonchain.com. We've got our newsletter, which we do twice a week, written and video. Again, just trying to explore the world how I see it through data. And we've got a charting website, which is very soon, hopefully by the end of this quarter, getting a big refresh. So stay tuned for that.
Awesome. Thank you so much, James, for being on. Also, thank you so much for everyone that is watching and listening for joining us today. As always, I'll be back. This content is for educational and entertainment purposes only and does not constitute financial advice.